Welcome to this special edition of The Business, coming to you live from Parliament House Canberra. I'm Elysse Morgan. Well, finally it's here, the final report of the Hayne Royal Commission. The public was hoping for heads on sticks, but instead we got a grinning CEO. Outselling the big issue today, ANZ boss Hayne Elliott didn't look too worried. And on first glance at the report, he needn't. Hayne hasn't recommended bankers go to jail en masse. But that's not to say there won't be sweeping and disruptive changes for banks, insurers, advisors and their customers. Tonight we'll go through in detail the key recommendations and what they mean for you. Coming up, we have Sally Loan from the Financial Services Council and the newly appointed bank watchdog, Graham Samuel. And we'll tell you, has the Commissioner done his job? We begin our coverage with Dan Ziffer.
Australia's banks are being forced to do better.
Just selling the big issue, guys, all right?
An early sign of contrition with ANZ CEO Hayne Elliott outselling the big issue this morning. In Canberra, the government dropped the bombshell recommendations of the Royal Commission. Commissioner Kenneth Hayne has referred a score of Australia's biggest banks and insurers to regulators APRA and ASIC for potential criminal and civil prosecutions.
From today, the banking sector must change and change forever.
Commissioner Hayne's report says it was greed that motivated staff and executives to knowingly break the law.
The conduct in issue was driven not only by the relevant entity's pursuit of profit, but also by individuals' pursuit of gain.
He proposes sweeping changes to banking, insurance and financial planning, including borrowers to pay upfront fees rather than commissions when applying for mortgages, limits on executive bonuses, in superannuation ensuring customers can have only one base level fund, and a board overseeing the regulators, although its work will be secret.
Today's report contains some very tough medicine for banks, including potential court cases.
Commissioner Hayne didn't let the regulators off the hook. The financial watchdogs have been slow to take action against big institutions and shy of going to court. Take how they dealt with the billion-dollar fees for no service scandal.
Conduct was treated as if it was no more than a series of inadvertent slips brought about by some want of care in record keeping.
From around the nation, traumatic personal stories informed the report. People who lost their houses through poor advice.
For them to do that to their customers is absolutely and utterly disgusting.
Problem gamblers given credit card limit increases.
I tried to reach out for help and I didn't get any.
Banks repeatedly putting their interests before customers. Of the big four, there was a special whack for NAB, accusing the CEO Andrew Thorburn and Chair Ken Henry of failing to learn from the bank's past misconduct.
Overall, my fear that there may be a wide gap between the public face NAB seeks to show and what it does in practice remains.
The Royal Commission's draft report diagnosed the sickness at the heart of Australian banking, caused by greed. This report prescribes the cure. Watchdogs need to enforce the laws. Suspected criminals need to face court. And banks need to stop ripping off their customers. Commissioner Hayne has done his job. Now it's up to politicians, regulators and bank executives to do theirs.
Dan Ziffer there. Now the hot take on some of the 76 recommendations that will reshape the trillion-dollar financial world. Let's take a look in detail at those that will hit the banks, their shareholders and finance workers. Joining me is ABC Business Editor Ian Verinder and Daniel Ziffer, who covered the Commission from day one for the Business. Both were in the lockup with me, spending some quality time with this tome from Commissioner Hayne. It's been a long time coming. The stakes were high. We'll take a look through some of the first of the recommendations, and one of the biggest is the mortgage broker recommendations. The first one says the borrower, not the lender, should pay the mortgage broker a fee for acting in connection with home lending. Ian, this is one of the several recommendations that will turn the mortgage broking industry on its head, isn't it?
Yeah, for sure. But you'd have to ask, why was it any other way? I mean, why is it that these people could charge so much money in commissions that were never really disclosed, and why the customer had no idea about this and, you know, thought that they were getting a good deal when in fact clearly from the outcome of the commission they weren't.
There are plenty of people who think they are getting a good deal from their broker, but as we've heard from several reports, including the landmark ASIC report from 2 years ago, it showed that loans from brokers are generally larger, take longer to pay off, and are generally higher cost than others. One of the other key recommendations for mortgage brokers is that they will now have to, if it's adopted by government, have to have a best interest test. Now, this is something that's been attached to financial advisors for some time. This is another significant step which will inevitably, like we saw with financial advisors, see brokers leave the industry, do you think?
I think so, yeah. I mean, it's going to be an enormous pain through that industry. You know, but clearly the interests of brokers and their clients weren't aligned. You know, as you just said, a broker had as their main interest to sell you the biggest possible loan at the best deal for them. And, you know, you'd have to, what other industry allows its practitioners to operate in other than the client's interest? Lawyers, doctors, name another profession where this takes place.
And still on the brokers, Dan, we've seen that the government hasn't quite recommended this as yet, but they may in time, and of course we may have a new government in a couple of months who may adopt it, that the borrower, not the lender, should pay a fee, that the commission structure should be replaced by fees, and that should be paid by the customer, not the bank, as it is now. This is something that, again, we've seen for other parts of the financial industry.
So we heard a lot of evidence on this particular topic from other jurisdictions around the world. In other places, customers pay this fee. Doesn't matter if they go through a broker, doesn't matter if they go through a bank. So they're trying not to kill off the broking channel, and there are multiple listed companies that exist entirely on broking. But they're trying to make it so that customers pay a fee for a service. They're moving away from the commission model. And as Ian said, it seems crazy that we have to say this out loud, but brokers have to work in the interests of their customers. That will be law.
And on that listed front, there will be significant issues for listed companies like Mortgage Choice and Yellow Brick Road. Taking a look at Mortgage Choice alone in FY18, in its full year result, $92 million of its revenue. That was a large part of its revenue was made up in trailing commissions. 70 million was in upfront commissions. So some significant changes for them there. Moving on from brokers, having a look at amending the banking code of conduct and other industry codes that we've seen. No longer will these be motherhood statements.
No,
Ian.
no. Well, I mean, it's always been a bit of a joke, really, isn't it? You know, the banking industry comes up with a new code of conduct. Well, what does it mean? It's got no weight of law behind it. So what the Royal Commissioner has said is you can have all the codes of conduct that you want, but if you agree with it and then ASIC ratifies it, then you have to stick with it. Otherwise, you'll be prosecuted. So it actually adds that weight of law behind this code of conduct, and I think that's a very positive move.
Dan, you spent some time during the Royal Commission looking in particular at the issues associated with rural lending and particularly on-farm lending. There was quite a lot in the Royal Commission report in regards to distressed agricultural loans and how banks should deal with those going forward.
So in some cases, the banks have moved already. They've felt the political heat, and they have, for example, no longer putting extra interest where loans in drought-affected areas are already in default or in trouble. But this will make them go further. So many of the stories from rural communities, and particularly from Australians in the farming sector, powered this commission into being. They were the majority of the people who would turn up to the sessions. They were the ones taking on the bankers outside, going to AGMs and asking questions. So some really substantial changes that won't fix all the problems, but for example, by making mediation compulsory, they're going to force the banks to really examine their own practices when they deal with these very large businesses that are subject to commodity prices and weather well beyond the impact of how well the farmer runs the business. So it's going to force them to take a more long-term view of these big issues.
They've also included in that the issue of fire sales, and this has been a real bugbear for a lot of farmers. You know, they get into trouble and then suddenly they find the valuation of their property doesn't actually account to the market value. The bank sells it off for virtually nothing, retrieves its own money, and then the farmer is left with nothing at all.
Mm-hmm. Very quickly, the BEAR, which is the Banker Executive Accountability Regime. Finally, some backsides will be on the line personally for the creation of products and also the remediation if those products turn out to be faulty.
Yeah, well, I mean, the big problem that any regulators had in the past is that no one actually takes personal responsibility for this. So who do you sue? And you'd launch action against an organisation. No one's taking any responsibility. There are no names on the line. So if this is implemented, you'll find that there's a lot of nervous executives there going, really, should I sign this? Let's check it through and make sure there are no problems. I think it's a crucial element.
Very quickly, National Australia Bank Chairman Ken Henry and the CEO Andrew Thorburn were absolutely savaged in this report. They are the two named people who really copped it. Are their positions tenable?
You wouldn't think so, would you? Not after what was said today. And a lot of critics have said, look, you've only had a go at them, Mr. Hayne, because they were bit rude during the course of the Royal Commission, the hearings. But, you know, change starts from the top. And so the Commissioner has said, if you're going to treat the senior counsel in this manner, clearly you don't hold any of these principles in high regard. So what chance has any reform got to take place within your organisation?
Ian Verinder, Dan Ziffer, thank you so much for your time. It's been a long time coming and expectations were high. The big question is, has the Royal Commission done its job? And can it get rid of the rip-offs and the rorts that have devastated the lives of so many? Here's Andrew Robertson.
Former policeman Andrew Crane has been battling NRMA insurance for nearly 8 years over a fire which gutted his house, the insurer refusing to pay up. He had high hopes for the Royal Commission.
And what I'm hoping for is that the industry is regulated in such a way that it's not up to the insurer to police their behaviour.
Andrew Crane can take some comfort from the knowledge that the Commission wants the regulators to step up and play a much greater role in policing the sector. Among the recommendations, Commissioner Hayne is demanding ASIC consider court action as a starting point when prosecuting wrongdoers. He wants more cooperation with APRA, reviews of both regulators at least every 4 years, and a new body to oversee them.
Long overdue that they've been found out for what they've been not doing. The problem here is, though, that we've got such a big, powerful, sophisticated banking and finance industry. Is anybody able to think of a regulatory solution short of taking away some of the power and size that they have?
But after the roll call of scandalous behaviour exposed by the Royal Commission, there was no body blow for the big four banks. Kenneth Hayne saved his harshest words, though, for NAB. But the report more a primer on how to do better, and despite all the Commissioner's tough words and some referrals to ASIC, he's refused to name anyone for potential criminal charges.
This isn't surprising. Royal Commissions very rarely lead to prosecution, and you've got to remember that the banking and superannuation industry is the most politically powerful industry in Australia.
But the Commission has targeted insurance and mortgage broking, in particular the conflicted commission-based payments which dominate them. It wants upfront and trailing commissions to go, which will force both industries to charge fees for their services. Mortgage brokers say they'll be decimated.
I would say under a consumer fee for service, potentially 70% of them, in excess of half of them. It would be a real disaster for our industry and a disaster for customers, because they will have less access to credit and certainly less access to competition.
At the moment, mortgage brokers work for the bank. Kenneth Hayne wants them to work for the borrower, acting in their best interest and being regulated as financial advisors.
The relationship that a broker has with its customer is far narrower than that with a financial advisor, with lesser conflicts. And that blanket bans on conflicted remuneration for intermediaries is not the right answer.
But while the Royal Commissioner has come down hard on mortgage brokers and insurers, there are some who believe he hasn't come down hard enough on financial planners. That's because some of the conflicts which fuel product sales influencing advice will remain. Professional standards and the fiduciary type duty we see in the legal world, and so in Bernie Ripoll's eyes, it's not yet entitled to be called a profession.
It's a great disappointment that not all the conflicted payments were dealt with. This leaves the consumers once again vulnerable and has money potentially being taken from their investments into the hands of the financial planners and other providers.
Dodgy financial planning is probably the biggest reason why the Banking Royal Commission exists. It's an industry dominated by the big four banks and AMP, even as three of the banks look to reduce their presence.
By not separating product and advice, you've left one of the major structural flaws in the system. It is very difficult for someone to get advice from a product provider that doesn't generally push their own product. What are they? Are they giving advice to you in your best interests, or are they there to sell you the product of their parent?
The Treasurer is choosing his words carefully, saying he'll act on all 76 recommendations, but he's already begun watering some down, a reaction some find very concerning.
This is the most powerful political lobby group in Australia, the banking and finance industry. They're already deeply embedded in both political parties, and the pushback's already begun.
Back in Port Macquarie in New South Wales, Andrew Crane will judge the Royal Commission a success if people like him stop being ripped off.
I'm hoping that the industry sees that they can't get away with the cowboy tactics that they've been relying on for so long now.
It will be some time before we know if Kenneth Hayne has achieved that.
Andrew Robertson there. As we heard in that report, critics say the Hayne report hasn't come down hard enough on parts of the financial planning industry. Sally Lone is the CEO of the Financial Services Council that takes in for-profit super, wealth advisors and insurers, and she joins me from our Sydney studio. Thank you for your time, Sally.
Pleasure, Elysse.
As we've heard, the government has said it will take action on, not implement, all 76 recommendations. Do you think there's room to convince the government that some of these recommendations go too far?
Look, I think that's something that, will be obviously debated for some time as we get into the detail. We have had a good look at a lot of these recommendations, at all of the recommendations, and a lot of them we endorse and have been endorsing for quite some time. Particularly things that would make a real difference to consumers. And one of these is actually enabling people just to default once in superannuation. Now, that's something that's been recommended for many, many years. The Financial System Inquiry recommended this. We've been advocating this for a long time. We think that's going to make a big difference. One of the things that came out in the Productivity Commission was the fact that there are 10 million zombie superannuation accounts eating up something like $2.6 billion worth of fees. That's coming out of yours and my wages. That can't last. This recommendation, I think, goes to the heart of cleaning up one of the most, one of the real inefficiencies that's led to very poor consumer outcomes. And it's really, I think, been a case of neglect. It's time now to fix that. That's something that we strongly endorse.
Something that you might not so strongly endorse. It's been recommended that all insurance commissions go to zero. Can the industry survive that?
Yeah, we're talking about life insurance here, and we've always said, and any life insurer will tell you, that selling life insurance is quite hard. People only think about it when they come to a few trigger points in their life. So this whole notion of having commissions has been around since the year dot. We worked very hard 4 years ago with our insurers, and we instigated an independent inquiry by John Trowbridge, a former APRA member, to basically say those high upfront commissions have to come down. That legislation has been instigated. The very high upfront commissions for life insurance salesmen, life insurance advisors are now coming down, and they will continue to go down. The government has said, let's see that legislation run for 3 years. We'll look at behaviours at the end of those 3 years and then see what we do. So going to zero immediately, I think, would be the wrong move. We want to make sure that those reforms actually work, and we'll need, as I say, that 3-year period to do that.
Your industries have had to be brought at times fairly reluctantly towards codes of conduct in how to treat their customers. Many of the codes of conduct really aren't worth the paper that they're written on, given that they're not enforceable. Do you support the recommendation that these codes of conduct be enforceable by the courts?
Absolutely. They should be enforceable by ASIC. We haven't been brought reluctantly to our code, our life insurance code. In fact, the Trowbridge Review recommended that we do instigate a code, and we got onto that some time ago. That code has now been up and running for the last 12 to 18 months. We're now working on the second version of the code. It is enforceable by the Life Code Compliance Committee, which sits in AFCA. So that is actually enforceable. We've always said that having that code registered with ASIC is something that we certainly have as a goal.
So you can guarantee that we won't see the likes of the ComInsure scandal again, where life insurers are finding excuses, and pretty poor ones, not to pay out?
Well, we have addressed so many of those issues. In fact, a lot of the recommendations that the Commissioner's made, we've addressed those in our code. We're going through the final process now of the second iteration, and we've actually doubled the size of the first code into the second code, and we think it's very good, and we think it will offer quite a lot of consumer protection.
Another recommendation is that fees must be renewed annually by a client, and this is to try and stop the leaching of fees out of ghost accounts and stop feeing dead people. Do you support this?
Yes. Yes, that's something that our members support. Ongoing service fees, they have to be accounted for every year.
On the superannuation front, you've already mentioned that you support the recommendation that people are only rolled into one default account, and that also that the fees aren't stripped out of those My Super accounts either. But there's some changes to the personnel rules around these, and that trustees can no longer hold any other office or any other role. Now, this would surely create some significant changes, because if there's one thing we know about the financial services industry, people hold a whole bunch of positions across it.
Yeah, and that goes right across superannuation, and I think that's an important recommendation by the Royal Commissioner. One of the issues that goes to the heart of superannuation is good governance, and what he's recommended is trying to get the best possible governance around superannuation trustees. Superannuation is, the heart and soul of a lot of the Australian financial services sector. It's managing almost $3 trillion of members' money, and this is for their retirement. So the stronger we can get governance around superannuation trustees, the better.
Sally Lone, thank you so much for your time.
Thanks, Elysse.
As we've heard bank lobbyist Anna Bligh say, the report is very tough medicine and that customers need to come first. All things we've heard many times before. But new banking overseer Graham Samuel says enough talk. The banks must immediately sign up to all of the Hayne recommendations and not wait for the government, which could take years. I spoke to Graham Samuel from Melbourne. Graham Samuel, ASIC has been severely criticised for its lack of regulation. Now it's been given more power to regulate and more things to regulate, including superannuation. Is this a good idea?
We've got to recognise that the criticism of ASIC that Ken Hayne has enunciated in his report relates to, I'll call it the former ASIC. It was the ASIC under the leadership of Greg Metcalfe. and commissioners that were in place then. Now, ASIC has been substantially restructured, it's been given more powers, it's been given more money, but importantly, it's got new leadership. James Shipton and others have been appointed, including, interestingly, Karen Chester, who was Deputy Chair of the Productivity Commission, but also led a capability review of ASIC. That capability review, unfortunately, was rejected in significant parts by the former chair of ASIC, and that's a pity. I think the fact that she's been appointed to the ASIC now as a commissioner indicates that the government perhaps expects that a number of the issues that she placed in her capability review will be implemented by the current leadership of ASIC.
People were hoping to see heads on sticks as a result of this report and Royal Commission. Do you expect that all of those institutions and perhaps the individuals as well that the Commissioner has recommended to ASIC for criminal charges, do you expect ASIC to follow through on that?
Well, I think it'd be very surprising if ASIC was to ignore the recommendations of the report, because after all, Ken Hayne is probably one of the finest jurists that has been produced in Australia in recent decades. He and counsel assisting and the enormous number of people in the background that have been working on this have done a significant investigation. But now it's up to ASIC to complete those investigations and then where it's a case of criminal prosecutions, refer them to the Commonwealth Director of Public Prosecution.
The government has also agreed to create an independently chaired oversight body to report on the performance of both ASIC and APRA. This was a recommendation of the Commissioner. However, the government has also said that this body will not have the ability to direct, make, assess or even comment on specific enforcement actions, regulatory decisions, complaints and like matters. What is the point of having a body that oversees the performance of a body like ASIC if it can't pull them up publicly and tell them that they're not doing a good enough job?
Well, I think there's a difference between telling a regulatory body that they're not doing a good enough job and having that oversight body, if you like, second-guessing what will have been the subject of intensive investigations and determinations by ASIC as the regulator in this case. Look, as former chair of the ACCC, I would not have wanted to have had another body second-guessing our views, our determinations on mergers or on prosecutions or the like. The body that does that, of course, is the courts. And that's the role of the Federal Court in particular.
And very briefly, these 76 recommendations, do you think that they're strong enough to seriously change banking culture and the culture within our financial institutions for the long term?
Good heavens above, if the banks and the financial institutions don't read this report and say, tomorrow, this is a very significant report. It tells us what we have been doing wrong. It tells us how to fix it. The same thing as what the APRA CBA report did. It said, this is what you've been doing wrong. This is what you need to do to fix it. And frankly, they ought to get on and do it immediately and start fixing their culture, their governance structures, their remuneration structures, the whole behaviour.
Graham Samuel, thank you so much for your time.
Thanks, Liz.
And that's all from this edition of The Business. For more on the Commission's report, go to our website. Join us tomorrow for a deep dive on what this means for your bank shares and the shockwaves now ricocheting through the industry. I'm Elysse Morgan. Good night.